A decade-long financial breakdown. There is perhaps no financial topic more polarizing than the choice between renting and buying a home. On one side, tradition dictates that buying is the only path to stability and wealth. On the other, the modern digital age argues that renting provides flexibility and the opportunity to invest capital in high-growth assets. Most people make this choice based on their monthly budget, but the reality of wealth building isn't found in month 1. It is found in year 10, 20, and 30. To truly understand the mechanics of this decision, we must look past the superficial monthly payments and analyze the hidden factors: appreciation, inflation, maintenance, opportunity cost, and the power of leverage. By following the parallel lives of two individuals with identical financial starting points, we can see how a single choice creates a massive wealth gap over time. The starting line: Jake versus Marcus. Consider two individuals, Jake and Marcus. Both earn a respectable $55,000 per year and live in a mid-sized American city. After years of disciplined saving, they each have $60,000 in the bank. They are both looking for a similar lifestyle, a comfortable 3-bedroom home in a safe neighborhood close to their workplaces. However, their philosophies differ fundamentally. Marcus decides to plant roots and purchases a home for $300,000. He uses his entire $60,000 savings as a 20% down payment, securing a 30-year fixed mortgage at an interest rate of 6.5%. His monthly obligation for principal and interest comes to approximately $1,517. When you factor in property taxes of $250 and homeowner's insurance of $130, Marcus is committing $1,897 every month to his housing, not including the inevitable costs of maintenance. Jake, meanwhile, chooses the path of maximum liquidity. He finds a comparable 3-bedroom house to rent for $1,400 a month. Because he didn't have to pay a down payment, he takes his $60,000 and invests it into an S&P 500 index fund, which historically averages around an 8% annual return. On paper, Jake is winning the first day. His monthly housing costs are $497 lower than Marcus's. He has no liability for a failing roof or a broken furnace, and he has a significant investment portfolio growing in the background. While Marcus is house poor, Jake feels market rich. However, this initial snapshot ignores the two most powerful forces in real estate: equity and fixed cost insulation, the hidden costs of ownership, and the compounding power of renting. The first 3 years of this experiment tell a story of stability for Jake and high friction for Marcus. For Jake, life is simple. When the dishwasher leaks or the HVAC system fails, he simply calls the landlord. His expenses are predictable: rent, a small renter's insurance policy, and utilities. By the end of year 3, his $60,000 investment, growing at 8%, has blossomed into approximately $75,600 without him adding a single extra penny. He is nimble, mobile, and his net worth is visible on a smartphone app. Marcus, however, experiences the friction of homeownership immediately. Before he even moved in, he lost $9,000 to closing costs, money that simply vanished into the pockets of lenders and title companies. Every year he must set aside 1% to 2% of the home's value for maintenance, roughly $3,000 to $6,000 annually, just to keep the asset from depreciating. Furthermore, because of how mortgage amortization works, Marcus's early payments are almost entirely interest. In his first year, over $15,000 of his payments go to the bank, while only about $2,800 actually reduces his debt. By the end of the third year, Jake looks like the clear winner. He has paid $50,400 in rent, but has a $75,600 liquid investment. Marcus has spent significantly more on taxes and interest, only managing to build about $9,500 in actual equity through his monthly payments. The Great Reversal: Inflation and Leverage. The turning point occurs around year 4, driven by a mechanism many renters overlook: the nature of fixed versus variable costs. Jake's rent is a variable cost. Every time his lease expires, his landlord adjusts the price for inflation and market demand. A modest 4% annual increase seems manageable. $1,400 becomes $1,456, then $1,514. But over a decade, these small increments compound into a heavy burden. Conversely, Marcus's principal and interest payment of $1,517 is locked in for 360 months. While the price of milk, gas, and Jake's rent all climb, Marcus's largest expense stays exactly the same. In real terms, inflation makes Marcus's mortgage cheaper every single year. The second factor that shifts the balance is leverage. This is the unfair advantage of the homeowner. Jake earns an 8% return on the $60,000 he actually owns. Marcus, however, earns appreciation on the full $300,000 value of the home, despite only having $60,000 of his own money in it. If the home appreciates at a modest 3.5% annually, by year 6, the house is worth $347,000. Meanwhile, Marcus has been chipping away at his loan, bringing the balance down to $269,000. Marcus now has $78,000 in equity. His money is working 5 times harder than Jake's because he is capturing the growth of a much larger asset. While Jake's index fund has grown to a respectable $95,000, his rent is now nearing $1,700 a month. The gap is closing, and the momentum has shifted entirely to the homeowner. The long game: the finish line versus perpetual payments. By year 10, the financial trajectories have diverged significantly. Jake has spent nearly $193,000 on rent and insurance. His index fund has grown to roughly $130,000, which is impressive, but his rent has climbed to over $1,870 a month. Marcus has spent more, about $285,000 when including all maintenance and taxes, but he is sitting on $170,000 of equity in a home that continues to rise in value. Marcus is now winning by a margin of nearly $60,000 in net worth, and the acceleration is just beginning. The most profound difference, however, appears at year 30. This is the moment Marcus makes his final mortgage payment. Suddenly, his housing cost, his biggest lifetime expense, drops to nearly zero, leaving only taxes and maintenance. He owns an asset that, after 3 decades of 3.5% appreciation, is likely worth over $700,000. He can live in it for free, sell it to fund his retirement, or pass it on to his heirs. Jake, at year 30, faces a very different reality. His rent, growing at that same modest rate, has reached a staggering $3,370 per month. He has no finish line. As he enters his retirement years on a fixed income, he is still writing large checks to a landlord for a property he will never own. When renting actually wins. Despite the long-term math favoring Marcus, buying is not a universal victory. Real estate is an illiquid asset, meaning your wealth is trapped inside the walls of the house. If Marcus needs cash for a medical emergency or a job loss, he cannot simply sell a bedroom the way Jake can sell a few shares of his index fund. Furthermore, buying is a disastrous financial move if you plan to stay for less than 5 years. The high entry costs, closing fees, and exit costs, 6% realtor commissions, mean that a short-term buyer will almost certainly lose money compared to a renter. Additionally, in hyper-expensive markets like Manhattan or San Francisco, the price-to-rent ratio is often broken. If a home costs $1.5 million but can be rented for $4,000, the math heavily favors the renter, provided they actually invest the massive difference. This is the ultimate if. Most renters do not actually invest the difference. They succumb to lifestyle creep, spending the extra cash on better cars, vacations, or dining out. For these individuals, a mortgage acts as a forced savings account that builds wealth through sheer monthly necessity. Conclusion: the importance of the 30-year view. The choice between renting and buying isn't about which check is smaller today. It's about which path leads to a finish line. Renting offers an easy start, no maintenance headaches, and the ability to move across the country for a new job with 30 days' notice. It is a strategic tool for the mobile and the disciplined investor. However, homeownership is a long-term hedge against inflation. By fixing your housing cost in today's dollars, you ensure that as the world gets more expensive, your cost of living remains stable. The real trap isn't choosing one over the other. It's making a 30-year decision based on a 1-month perspective. Whether you choose to be a Jake or a Marcus, you must run the numbers past the first year. Recognize that rent is a bill that never ends, while a mortgage is a debt that eventually dies, leaving a powerful asset in its wake. Understanding this trajectory is the only way to ensure that you are building wealth for your own future, rather than simply subsidizing the wealth of someone else.